I looked at 100 deals this month, and 98 of them are absolute garbage. Brokers are still selling fairy tales. Sellers are pricing like it's 2021. And if you don't know what to look for, you're going to get crushed. In this video, I'm going to walk you through exactly what I'm seeing behind the scenes right now. From real underwriting fails to 2 deals that I'm actually moving forward on right now. If you're serious about investing in 2025, then you need to hear this, because most people are about to learn these lessons the hard way. So how many of those 100 deals are actually worth a second look? And which ones immediately were disqualified from the rest? Number 1, pro formas that use unrealistic rent growth and 2023 comps. 2, sellers that are still anchored to old capitalization rates. 3, expenses wildly underestimated based on actuals, especially taxes and insurance. Anytime you see expense reductions, run. Or the value add is already priced in and there's no more upside. So what's the biggest disconnect between a seller or broker on what's being presented and what's actually true? The first big red flag is rent growth and rent projection is based on the future and not actuals. The second is high vacancy and even concessions that are being used to incentivize tenants. Because concessions are just reductions in income, they're really more like an expense. Expenses are up across the board. We all know this. We're all dealing with inflation. So things like labor, utilities, insurance, property taxes, and just all the components that it takes to actually fix or build something are way up. So whenever the net operating income doesn't reflect like concessions or delinquencies or lease trade outs, then I move on, and I move on quickly. And if the investment is based on a 2026 refinance play, then you better run, because today's debt could remain this high in the foreseeable future. And lastly, if the seller or broker are projecting lower capitalization rates on the exit, then all they've done really is just fabricate a higher value in the future. So cash flow deals are rare, but they do exist. Of the deals that I did like, they all had the same things in common. They were self-managed with high expenses and had easy operational upside. Typically, these had higher vacancies and they were mom and pop type managed. One deal that we recently bought in Arizona, the owner lived in Florida, had owned it over 20 years, and rarely visited the property. This is the kind of deal I'm talking about. Another indicator is that rents are 15 to 20% below market. Now, market is exactly what a renter would pay today, not tomorrow, not in the future, but today. If there was a vacancy, what's it priced at today? And from there, your rents should be 15 or 20% less. And in many cases, in many deals, you can find this. I like to look for properties in secondary markets where there's not a lot of institutional competition. Institutions typically favor highly populated core markets, and therefore there's a lot of money chasing few deals. Gold is near all-time highs, but appreciation isn't the only way to benefit. Monetary metals, you could potentially earn a yield on your gold, paid in physical gold, without selling it. Here's how it works. When you lease your gold through their platform, pre-qualified companies pay to use it under strict guidelines, like renting out real estate, but with gold. Instead of paying to store your metal, you may earn up to 4% annually in gold. You stay in control, and you can choose which leases to participate in. Monetary Metals handles the due diligence, lease terms, and all the administration. Thousands of investors use this approach to grow their gold, not just sit on it. Visit monetary-metals.com/Ken to learn more. Leasing gold involves risk, and returns are not guaranteed. This is not an offer to buy or sell securities. Please review all risk disclosures at monetary-metals.com. Visit monetary-metals.com/Ken to learn more. Another one is I look for properties that don't have any recent capital improvements. My experience is a lot of real estate investors distribute all of the money, and then they don't have any money left over to do the basic maintenance, like the painting of the buildings, the roofs, the parking lots, and those kinds of things. Those oftentimes can be great assets to acquire. All you need to do is what we say, put lipstick on a pig, and just paint them, put new roofs on, redo the parking lots and some of the landscape, and maybe the fitness center, things like that. Things that tenants would want. You guys have seen this, of course, when you take over an old house and just renovate the kitchens or upgrade the flooring, those kinds of things, except for commercial apartment buildings. Those kinds of things can help draw more tenants and command higher rents. Another thing that we're looking at is, of course, land for new construction. Now, why would we build new construction today? Because any new construction that we build today is going to open in 27 or 28, when there's not a lot of new supply hitting the market. So once this disruption stops in the market, it all starts to firm up in 2026. And then in 27 and 28, we should see high rent growth again because there won't be hardly any supply entering the market at that time. And if you are an accredited investor and want to see some of those deals that we're working on, just click the link here. So if someone is actively looking for something right now, what should they be looking for? Mom and pop sellers with fatigue or partnerships that are being broken up right now, or loan maturities, mismanaged portfolios with negative NOI growth, properties that have a lot of deferred maintenance. A lot of investors are afraid of these, but I look at them as great reposition opportunities. And off-market direct-to-owner still works. Cold outreach still works. So what are the top 2 or 3 deal structures or conditions you're walking away from immediately? Negative leverage on day one. So what does that mean? That means that the occupancy doesn't cover the expenses. You got to be very careful with these deals. I just looked at a deal the other day that was $40 million and the lender was going to sell it for $14. The loan on the property was $25 and they were going to take an $11 million haircut on the loan itself. And even at $14, I passed. Sometimes you're stepping right into the lender's shoes and you're just catching a falling knife. Be very careful as you're trying to buy some of these distressed assets. Walk away if a seller needs bridge financing and the deal doesn't pencil today, just to get through the next period of time. Walk away if syndicators are using really aggressive rent growth numbers and really aggressive expense cuts, and they have very thin margins at that, and there's no operational upside. Walk away. And if they say it'll cash flow after refi, walk away, because they don't know, just like we don't know, what interest rates are going to be in the future. All real estate deals must have a story. It must be simple and straightforward for everyone to understand. And it should not be pie in the sky based on some future analysis of what might happen on interest rates or rent growth or expense cuts. Be very careful, and all deals need to underwrite and cash flow at today's numbers. So the market pulse, what's shifting right now? So based on what I'm seeing in real time, what trends are unfolding behind the headlines? Price expectations are finally starting to soften in many markets. Cap rates are going up, and lenders that used to extend and pretend, they're not extending anymore, and they're not pretending anymore. They're actually starting to put some of these deals on the market, finally. Expenses like insurance premiums and property taxes continue to go up, killing cash flow. This makes it even worse, and the only thing that can help is going to be the low interest rate costs on potential debt. So always underwrite higher expenses in the future on any deal that you're trying to buy today. The real estate market is not repeating what happened in 2008. In this next video, I'm going to go over exactly what is happening. In this video, I'm going to break down 3 charts that every serious investor needs to be watching. 1, the 10-year Treasury. This is the indicator that's the most important for commercial real estate. 2, how inflation and tariffs are going to affect commercial real estate in the future and how you should be underwriting your deals. 3, the renter nation shift has started, and it's going to give real estate investors a huge advantage in the future. This cycle does not look anything like 2008. Yet a lot of investors are treating it that way, and they're making a lot of mistakes like they did in the last cycle. They're making the wrong moves, and you need to make the right moves to reflect the issues of today. So if you're building, buying, or just trying to time this market, I highly recommend you watch this video next.